Jyotivardhan Jaipuria, Head of Research with BofA-ML, which is Bank of America Merrill Lynch, joins us live with his market take. Jyoti, good morning and good to have you back. Jyoti, do you like pharma still? Because that's been your favorite theme for last 2 years now.
Yeah, so pharma is one of our top overweights. I've liked it for a long time. I still continue to like it. It's a space where we think there are lots of companies which have visible growth prospects, which are not dependent on US economy, Indian economy, global economy. So it's something which is a little more secular, and which you can play with that. Okay, I have some assured growth without really worrying too much about the environment.
Even so, you won't talk about stock-specific names. As we were just discussing with between ourselves, Nikunj and I, about how the rally in Aurobindo Pharma, that's just a case in point that I'm taking, post-earnings, has not been as exaggerated as it would have perhaps been in a normal situation if the stock had not run up ahead of the numbers. So it's been an unprecedented 170% gain over the last year or so, but up 5% on the reaction to earnings, which have been splendid.
Yeah, because of all the research which is done now, lots of stocks anyway, people are anticipating changes in earnings trajectory, and that's the reason lots of stocks move up ahead of the earnings really, because you have a growth part which people can forecast. So I think analysts are doing the job if the markets are moving up ahead of really the earnings numbers coming through.
With Jyoti, it is very, very difficult to get any stock-specific comment, and I respect his compliance there. So Jyoti, let's talk about flows. Where is all the money? Foreign institutional investors pumped in $4 billion in the month of December, and the minute December 2013 became 1st of Jan 2014, the money also has dried up. I mean, just because the calendar year has changed, why should the pattern change?
Yeah, so in December when we had done our report, we had actually pointed out to this that December typically has been a seasonally very strong month, and it is generally followed by a weak start to most years. So our view was that the impact of tapering would mean that we'll get a pullback in the markets early part of 2014, which is what is really playing out. So if you see, it's all really global, right? You're seeing emerging markets having outflows, you're seeing global equities having outflows, and that is reflecting in India also. In some sense, probably India's been better off because our currency's been rock solid at a time where a lot of other emerging market currencies are taking a beating.
I just wanted to put in one more question on your outlook on pharmaceuticals. While you're saying that pharma companies are going to do well because there's not much dependence on US recovery, the fact is that US FDA has played havoc with their functioning on domestic shores. So what's the call on the pharma sector, and have you kind of reviewed all the announcements and the impact on earnings as well as the visibility on these stocks?
Yeah, so pharma is actually a more stock specific sector than really a lot of other sectors, because there are companies which will do well, companies which won't do well. Essentially what we always try and look is where are the FDA filings, what are the chances of that going through, and what is the sort of impact that can have on future earnings. So that's why it's not necessary that you remain bullish on the same stocks through the 4 years or 5 years, though you may remain bullish on pharma, because there are different stocks which are at different stages of filing, at different stages of approval. So it's as you come closer to a lot of approvals, you want to buy that stock ahead of the earnings really coming through, and at some stage you will find that some stocks have finish most of their approvals, the pipeline is lean over the next 12-18 months, and then you may want to switch to something else.
Jyoti, tell me a bit about your model portfolio. What are your key overweights for 2014? What are key underweights for 2013? And where is the risk-reward ratio stacked up?
Our model portfolio is like a mix of stocks which have done well for the last few years, which are essentially high quality stocks, and stocks which have done very badly for the last few years. So what we are trying to say is we could see a sector rotation starting sometime in 2014, and so start moving your portfolio a bit to some of these stocks which have underperformed, which are totally underowned, and where maybe incrementally things could change. But yeah, it's going to be a very slow and steady thing. It's not something you have to do in a hurry, because the recovery is going to be slow. In the interim, you'll get a lot of bad news. So use bad news to buy some of these stocks. So pharma is one of our overweights and IT is the other. So, that I think is a very consensus trade. Everybody's playing it. Our third overweight is autos actually. So autos is something which we have quite a strong overweight in. Basically, we think interest rate cycle is starting to peak out. We could see some cuts happening towards the later part of this year, which would help auto demand. The other thing we are overweight on is energy. So it's basically the oil public sector companies that we are overweight on in anticipation of reforms continuing, which would improve the situation for these companies.
The whole infrastructure power sector, Jyoti, and while they may not be your overweight sectors right now, at some point in time, as most analysts were speaking about the defensive versus cyclical trade, these stocks will become a fancy of the market. When do you propose that would happen?
So, my view is that as the recovery starts, or as things start to improve, we need to see some change, and the change would come probably in two directions. One would be interest rates having peaked out and they start to get cut. So that is what would help the infra stocks, it would help real estate stocks, it would help consumer discretionary stocks. The other change probably comes about once the elections is behind us, because the next 5 months it will be difficult to pass any reforms. It's the last parliament session we are seeing now. But once we have a new parliament in place and a new government in place, then it gets easier to do reforms, which probably would help in some sense improving the investment environment in the country. So, a combination of both of these could start improving infrastructure sector, could start improving the outlook for this sector. But we must remember it's going to be a slow process. There's no quick fix here that, one day suddenly the switch is on and investment demand in India starts picking up in a big way. Because a lot of these companies which invested over the last few years are not making the sort of returns they anticipated they would make on their projects. Second is, a lot of them are sitting with a fairly heavy debt profile, and to that extent they may not be really in a position to start another round of capex very quickly.
Right. Just one more question, adding to that, and that's on earnings pickup. We were just talking to Saurabh Mukherjee a little while back from Ambit Capital, who spoke about consensus earnings in FY15 to be about 15% right now, but over the next 3 to 4 months, there would be a downward revision on those earnings closer to the 9, 10, perhaps even 11%, that range. Is that something that you're going by with as well on the drawing board, reworking earnings downwards as you do not see the anticipated kick in the earnings cycle?
Yeah, my theme for the last 4 years has been that earnings will get downgraded, and it's something which is very typical as we start the year. Analysts have a very optimistic view of the earnings for that year, and as we keep moving into the year, analysts keep cutting earnings once they start looking at it more closely. I guess the issue is everybody just anticipates that we are going to have a major turnaround in the economy in the next year, and that turnaround does not happen that quickly. It's always a slow and steady process. So I think we'll see earnings downgrades for FY15.
Liquidity is likely to remain tight. Earnings are unlikely to bottom out. The core global concerns are not over, and interest rates for the moment are unlikely to come down. What is the bull case scenario? Why buy into equities at all? Because one by one, all the bullish arguments are only getting challenged.
Yeah, so the bullish scenario for equity simply is, are we close to the bottom? So for the last 5 years we've seen earnings downgrades. For the last 5 years we've seen GDP getting marked down. GDP today is much lower than what it was 5 years ago, and even 3 years ago if you had asked people will be at sub 5% GDP, people would have said no, this is not likely. So are we looking at a scenario where we are getting close to the bottom? What could trigger a revival? And would be again those two things. One is once we have elections out of the way, you're a new government which probably will find it easier to take decisions because electoral considerations will be behind us. Second is you could have earnings starting, interest rates starting to get cut, and once interest rates start to get cut, plus you have a reform starting to pick up, then people will start getting a bit more comfortable that okay, we are looking at things which are probably closer to the bottom, we could see things start to improve. Let me just give you one anecdote here, that margins in India today are at like a 18-year low. So if margins were to revert to mean, and it doesn't need to go to like a peak or something, it just needs to revert to mean, earnings probably doubles out over the next 4 years or something. So that's the sort of thing you could have if things start to pick up, as an operating leverage starts to pick up.
And if it doesn't? As anticipated, I'm just saying that there are delays in the time.
If it doesn't, then you'll just continue. Yeah, see, I'm sure this is not going to be like one straight line process that one day suddenly earnings are picking up. And so you'll continue to have this grind. Basically what we've been having in the market is things not looking great, market going nowhere because people are just hoping that there's a recovery, so the downside gets protected. At the same time, without any visible signs of recovery, you can't see markets really going up too much. See, markets are not so cheap that anyone can say, okay, I'll just buy and hold because this is just too cheap. Markets are fairly priced, so you're not really going to get too much of a re-rating from these levels. So essentially you need earnings to start coming back to give you returns in the market.
Make money in this kind of a market, because we are in a trading or a range bound market for the longest time. Closer to 6350 there are only sellers, closer to 5800 or 5600 there are only buyers. Is that the best way to trade this market? You go 10% higher, you sell, you come 10% lower, you buy?
Yes, let's say from now to elections or close to elections, I think that really is going to be the scenario. Post the elections, then I think we may see moves in the market probably once we get the results and people are clear of what sort of government we are getting, what sort of reforms we can anticipate from the government. So I think that's where we'll see a big breakout happening in the market. Till then, I think it is going to be like a range bound sort of market.
Range bound with them, because we see the market readjusting sub-bus. We haven't cracked below 6,000 in a conclusive manner, but that broad range between 6,000, 6,300, now the opinion seems to be building more towards 5,700, 6,000. So what's the kind of range that you look at over the next 6 months?
So, our printed view has been that in the early part of the year, we'll see markets probably coming down to 19,000, 19,500. So, that is what we said in December, and we just continue to stick to that. So, that's probably where, you probably want to nibble at the market.